How to get a hard money loan with no monthly payments. All right, guys, so most hard money lenders are going to require that you're making a monthly payment on that loan. But in a few exceptions, there's hard money lenders that will let that interest be a part of the initial loan that you're doing as long as you're buying the property at a really good deal. Not just a good deal, but a really good deal. And that's one of the things that we do. So I want to show you exactly how that works. Basically, what has to happen is you want to be buying it as a percentage of the ARV, or after repaired value. So for example, if the ARV on this property was $100,000, you would need to be at about $74,000. Now, that could be a little bit more, or it could be a little bit less if there's some deductions based upon the area or some of those things. But 74% is a good starting point. It's rarely going to be higher than this. I mean, it might go to 75. It could go lower than that based upon some things in the area, which are deductions because of risk. This could be crime in the area. This could be near railroad tracks, near commercial properties, or those things. Those are going to have deductions on the loan to value or loan to after repaired value that we're able to do. So in this, we're just going to use 74%, knowing that there can be some adjustments on that. And so that means that my purchase price, my rehab, my interest, origination and loan fees, and my title fees cannot exceed $74,000. So let's just say that my purchase is 50,000. Actually, it's going to have to be less than that. Let's just say my purchase is 40,000, and let's say my rehab is 20,000, and let's say my interest and fees is 12,000, and my title fees is $2,000. Then if all of that adds up to the 74,000, then I'm coming up with no money as long as the appraisal comes in and the value is where that needs to be. What's going to happen is the appraisal is going to justify the ARV, because if this goes down, then there would be come up with some cash flows. If it goes up, there would be even better. And the second thing is this rehab is going to have to get verified to make sure that it's fair market and it's the scope that's needed to be done based upon other properties in the area. So those are the two caveats as we're dealing with that. Okay, so then you may be saying, well, how do I know what all of these costs are going to be? And that's why we have our advanced deal analysis. So you can come in here, you can do analyze a deal, you can put in a zip code, and it's going to automatically tell you what all these costs are going to be for that specific deal, so you can know what your estimated profit is. And this will also do the calculations for you where it says if you have to come up with some cash to close. For example, in this simulation, there's $23,000 cash to close. Well, let's just buy this property for a little bit less. Calculate. And let's see what it does, how much we'd have to come up with. It's basically running the simulation. It's saying, okay, if it's worth $250,000 at 74%, can the purchase, the rehab, the title fees, the loan fees, and the interest come in? And yep, zero cash to close. So what this means in this specific example here, 100,000 purchase, 40,000 rehab, 250,000, you'll see that the days on market is a little bit higher. We have these nice little question marks so you can know exactly what it is. But then this adds up and says, okay, here's your title fees, here's your attorney fees, here's your compliance fees, here's your property tax credits, here's your inspection fees, everything. And that's going to come to $183,000. Okay. In this scenario, we could have lent up to $185,000, which means you have a zero cash to close. But then we come down here and say, what's your estimated net profit? Well, in this deal, it's $47,608. So we take the 183, but then we have to take the title fees and the agent commissions, which ends up being $17,000. That's your resale amount. You've got some holding costs, some inspection costs, and some valuation costs, which is going to put you at about a $47,000 profit. So how can you get a deal where you're not having to make monthly payments? Well, the first thing you're going to have to do is find a lender that's going to allow for that. There's very few that are out there. We happen to be one of those. The second thing that you're then going to have to do is make sure you're buying a really, really good deal. A good deal probably isn't going to justify that, because let's just say that this ended up being $10,000 more. So this was $84,000. Then what would happen is you'd have to come up with $10,000 to make this deal happen, or you would have to get a price reduction by $10,000, and then you'd be coming up with no cash to close. Or maybe the appraisal comes in more than you think. I wouldn't plan on that. That usually doesn't happen. Or your rehab costs can come in a little less than you think. That also usually doesn't happen. Usually we find rehab costs are a little more than we think. We find that values are a little less than we may think. So knowing that those are, the next thing we can do is negotiate with the seller, or we have some creative financing ways that we can show you in part of our ways to partner with the seller to make a deal happen out of this. So at the end, it's got to be within that 74%. Use the calculators. That makes it really easy for you. Get a good deal, and you cannot be making monthly interest payments along the way.